The yield curve is back to inversion. The NASDAQ is selling off. Value stocks are going higher and jobless claims are up. We all want a soft landing, but I don't think we can rule out a recession just yet. Let's take a look. Yield curve inversion has preceded every recession for over 6 decades. What we're looking at here is the spread between the 10-year Treasury and the 3-month T-bill. When that spread is negative, below the zero line, we have an inverted yield curve. When the spread is positive, we have a normal yield curve. You see that most of the time the area of this chart is above the zero line. Only in rare circumstances do we have an inverted yield curve where the 10-year Treasury yields less than the 3-month T-bill. And historically, that unusual set of circumstances has happened before a recession. Typically, the yield curve inverts and about 13 months later, the recession shows up. But that's not always the case. As we can see here in the late 60s, we had several years of inversion before the 1970 recession hit. Generally, when the curve goes from being inverted to de-inverting, i.e. no longer inverted, that is when the recession is about to show up. We can see that happening in 1982. You see that we are inverted right here, and then we de-invert and the recession shows up. 1991 recession, we're inverted for a brief period of time. We de-invert, we go back to a normal curve, the recession hits. The year 2001 recession, we are inverted and then we de-invert and the recession shows up. 2008, same pattern. We are inverted, then we go back to a normal curve, we're de-inverting, recession hits. Look where we're at today. Massive inversion. It's gone on for a long period of time, longer than normal. No recession, but look where we're at. We recently de-inverted and now we're inverted again. It may not be long before a recession arrives if this indicator is still valid. Unemployment is still very low at 4% and well below the long-term average of 5.68%. The issue with tracking unemployment is that it is a lagging indicator, and you're generally in recession once the unemployment starts to spike, just like it did in 2008, 2001, 1991, etc., etc. When you look at all the past recessions, you see that it just explodes to the upside very fast. And you're already in recession once that's happening. It's a lagging indicator. When you look at unemployment, you can tell that it never stays in one place very long. It's always trending down or trending up, trending down, trending up. That's because of the Fed's dual mandate. They're constantly vacillating back and forth between trying to stimulate the economy and create jobs, but also control prices. Very difficult position that the Fed is in. My concern when I look at the unemployment graph is that it appears we have bottomed out and the trend may be reversing. Maybe we'll have a situation like we had here in the late 60s where we went sideways for maybe 2 years. Maybe that's going to happen. Maybe we can kind of go sideways for a year or two. But keep in mind what I said before. The trend is generally going up or going down. So if we have a new trend, we're probably going to see unemployment start to creep higher. And then it's generally just a matter of time before we have a recession. Market leadership appears to be changing. If we had started the year with $100,000 in the Russell 1000 Total Return Growth Index, we're now at 99,000. If you had started the year with $100,000 in the Russell 1000 Value Index Total Return, you're now at roughly 104. There's about a 5-point spread here. Now, I don't know if this is just temporary or if it's the sign that we are going to see a major change in market leadership for a long period of time, but I do find it very interesting because market leadership changed in the early 2000s and that leadership lasted for over a decade. Let's take a look. In the year 2000, market leadership changed away from growth and tech stocks and in favor of value stocks and stayed that way for over a decade. What we're looking at here is an illustration for a $100,000 investment in the Russell 1000 Total Return Growth Index the orange line, versus a $100,000 investment in the Russell 1000 Value Index total return, that's the purple line. And you can see that by October of 2011, the growth index was at $76,000. Over a decade of losses for growth and tech stocks. Very painful. Value stocks, on the other hand, were positive. You can see that they were up almost 40% for the same time period, $137,000 plus ending value in the index on October 11, 2011. I don't know if we're at the beginning of the business cycle shift right now, but I do find it very interesting that market leadership has changed in early 2025 in favor of value stocks. And this time period was marked by not one, but two recessions. So maybe we are looking at the business cycle turning and possibly a recession on the horizon. If you have questions about your investments, please give my office a call. We would be happy to give you a free second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.